Welcome everybody. Good afternoon. This is day one of the 2021 Debtors Bar of West Michigan seminar. For those of you who don't know me, I'm Ryan Beach and I'm serving as the chairperson of the seminar this year. I'd like to take this opportunity to throw out some thanks. First of all, to Fortz Legal Support for help setting up all the Zoom services, the seminar committee who helped organize the event, everyone who's here today, and of course, our speakers who have not only generously donated their time, but have also given us some really great material. So if you haven't checked those out yet, I highly recommend that you do. You should have received those materials for today. The materials for day two will be sent out later today. But if for some reason you haven't received those materials, or if you have any questions or issues, you can send an email to the same address that you registered with the Debtors Bar Seminar at gmail.com. I've been told by Fortz Legal that day two, which is scheduled for this Monday, we'll use the same Zoom link that was used for today, so you can use that same one. And again, everyone should be receiving another email prior to Monday with those additional materials. I did want to give a warning to everybody who practices in the Western District. If you typically use this seminar to meet your CLE requirements, this seminar will not be enough to meet the minimum 7 hours required by our fee memorandum. So you're going to want to check out some other educational opportunities throughout the year so you can get that elevated no-look fee and hourly rate. So for today, we have two panels. The first panel is advising consumer debtors on income tax debt, bankruptcy and non-bankruptcy solutions, and that will be followed up by a case law update. Again, I want to thank everybody, and now I'm going to hand things over to Chris Jones, an attorney from the Eastern District, and Terry Zabel, an attorney here practicing in the Western District. Thanks, everybody.
Thanks, Ryan. Everybody can hear me okay, presumably, right? Good. Okay, great. Thanks again. My name's Chris Jones. I do debtor work primarily in the Eastern District of Michigan since, I guess, going back about 15 years now. My practice focuses on consumer debtor work, although we do see a lot of crossover with self-employed individuals, and inherent with that is dealing with a lot of income tax related issues. So I'll be presenting for probably close to the first half of the session with respect to the bankruptcy side of things. I have with me Terry Zabel. Terry practices out of Grand Rapids and focuses his practice, although some interplay with bankruptcy. It's primarily tax debt. He's worked for the IRS, Department of Treasury, and has a vast amount of experience on that end of things. He's going to kind of pick up where I leave off and discuss non-bankruptcy solutions. Ultimately, there's a lot of holes in what you can effectively resolve using bankruptcy based on the various non-dischargeability implications. And you'll find that having a close contact to help guide you and your clients through non-bankruptcy options is really important. You're doing your client a disservice if you're only evaluating the bankruptcy side of things. You can do, I kind of take for granted that the majority of the audiences are bankruptcy practitioners, but don't sell your client short. Make sure if you're identifying which almost every single prospective client with tax issues, there's going to be some non-dischargeability implications somewhere, and the client needs to be advised of it, and potentially in advance of taking bankruptcy action on their behalf, they should consult with a tax professional as well. So I'm going to launch right in. I've got some slides prepared that I'll set the screen up with and move through. Terry and I have decided that it's probably best to keep this fairly free flowing. I'm going to use the slides as kind of just to keep me progressing, keep me on track, and serve as my note cards but we welcome feedback in the chat function. Terry's going to watch that while I'm speaking. I'll watch it when Terry's speaking to try to keep us mindful of audience participation or interest. If something is interesting and you want to talk about it, leave a message in the chat and we'll try to focus some time on it. So I'm going to switch off. I'm going to share my screen here to get my slides up, and then we'll kind of go from there if I can figure this out. Oh, there we go. Okay, Fortz Legal did such a good job. I'm now a professional. That's the highest level of recommendation I can give. I could figure out how to share my screen. I even did a title page there for us, so that looks great. All right, I spent a little bit of time. This is challenging, of course, because with these mixed audiences, I never know, and taxes specifically are so nuanced, and there's so many considerations that you could pick one of these 14 slides and spend half of a day parsing out various factual and legal nuances to discuss. And we can't do that, obviously. I'd like to sometimes, but we can't. Then again, we don't want to make it so vanilla that nobody takes away anything. So I'm trying to strike a balance here in that respect. And hopefully the chat and feedback can help move us in one direction or another if we're not accomplishing that. Again, I listed some statutory framework here for consideration when we're meeting with prospective tax clients with tax issues. The two key code provisions, 523, which is your non-dischargeability provisions, and then 507, which is it's priority claims, but 523 incorporates 507 such that if it's a priority debt, it's by nature non-dischargeable. Anytime you're meeting with a client, your focus is going to be 523 and 507 with respect to evaluating non-dischargeability implications. I'll go back here. The 523 is where you'll find your 2-year rule, is what you call it, essentially ensuring that the tax returns have been filed for at least 2 years. You have your non-dischargeability implications tied to unfiled returns, fraudulent tax returns. And of course anything, and that's where it ties in 507. You move to 507, which discusses generally priorities. Well, many provisions of 507 deal with the income tax implications. I tried to summarize them here at the bottom. You've got your 3-year rule, i.e. the tax return year must be at least 3 years. The due date for the tax return has to be at least 3 years from the petition date. Your 240-day rule, that's essentially the taxes must have been assessed for at least 240 days. And you've got your trust fund taxes incorporated into 507 as well. So 507 and 523 is where you want to be in terms of understanding the interplay of all the sections. I don't want to get bogged down in just sort of reading through the code and interplay between those two sections. I want to try to get to some practical considerations when we're consulting with and advising clients and treating claims in these bankruptcies, in hopes of hitting on something useful, some takeaway that people will be interested in. The first thing that my first slide is, I think, most important, which is pull the transcripts when you're meeting with a client that has tax problems. Inherently, your clients with tax problems may not be as organized as you'd like them to be, to put it nicely. So you don't want to rely on what they may in good faith believe that something is happening, or they've received something, or something happened in the past 8-12 years ago, but they probably don't remember or didn't know what was happening. So the IRS has available a wealth of information in the form of these various transcripts. I broke them all down here, provided a link. Although I'll have to figure, I think I left this link out of the actual materials. You can Google this transaction code pocket guide and pull up a PDF, and it's handy to have when you're reading through those transcripts, understanding what the various codes on the transcripts means, because identifying those events throughout the tax history is going to help you understand and tie in and analyze the bankruptcy non-dischargeability implications, such as the 3-year rule, 2-year rule, 240-day rule. So pull those transcripts and understand them. There's various ways to do it. You have your client do it, you can do it. But the bottom line is you want to have in hand the account transcript and the tax return transcript when you're trying to evaluate effectively on behalf of a client. The way I approach, and I'm certainly not saying my way's best, and don't want to substitute my process for anybody else's, of course, but I'll just quickly mention, I approach these consultations from the perspective of, I want to know, and usually do know right away, why are you here? Are you in my office based on primarily tax problems, or are you here, which is more often the case, they're there for related problems, mortgage foreclosure, car repossession, other collection activity. If that's the case, especially if those other non-tax issues are creating a time-sensitive push and are going to dictate the timing of the filing of the case, a lot of the stuff we're going to get into about being mindful of timelines is you're kind of handcuffed, of course, because you need to take action to protect the asset. So of course, when we get into that stuff, that's assuming that you have the flexibility of time when you're consulting with a client. Be mindful when you're meeting with a client that income taxes are not consumer debt. That is important for a couple of very key reasons from my perspective. It's not consumer debt, and thus a debtor with primarily tax debt is not subject to 707B in your abuse provisions when it comes to Chapter 7 and prospective motion to dismiss your case. So you got a lot more flexibility if you have a debtor with primarily tax debt, thus primarily non-consumer debt. You have a lot more flexibility in terms of their income and eligibility for Chapter 7, because you're not constrained by the means test and you're not constrained by this abuse standard. Instead, if a Chapter 7 non-consumer Chapter 7 case is going to be dismissed, they have to meet a much higher bad faith standard as cause under 707A. So to me, that's a stark difference and something you should be right away aware of, that might provide a benefit to a client. The downside is being strapped with a significant amount of income tax debt, but it might provide you a real benefit in being able to get their debts discharged with the Chapter 7, and ultimately, if there are some non-dischargeability implications, you'll call Terry and he'll fix it all for you afterward. But the bankruptcy can at least resolve the other stuff. The other component why it's important is non-consumer debt. There's no co-debtor stay. Some of us I know I do. I get really comfortable with the co-debtor stay and clients having some peace of mind with respect to their co-debtors, at least while the bankruptcy is pending. Well, I see this often where a debtor will file, they're the responsible party for some business taxes, or they're married, and collection can and will continue, especially as to a business. If they're treating withholding taxes where they're the responsible party, the service, in my experience, will continue collection action against the non-filing entity. And so you don't want to give a client a false sense of security in terms of oh, my problems all go away, I'm paying back as a priority claim. this withholding tax. So, and same with spouse. That's less common. Clients typically understand that if they file a joint tax return and they have a jointly liable spouse. Although sometimes there's a misinterpretation by clients. They don't believe that if the business is theirs, but they file a joint return with that spouse, they don't understand that the joint liability resulting from the jointly filed tax returns is a liability of that spouse. Not necessarily, now that does, of course, doesn't go in terms of responsible party for trust fund taxes, but just general income taxes. So keep in mind, tax debt's non-consumer debt. Let's see here. So this, I kind of just try to summarize the 2-year, 3-year, 240, the big things that alarms should be going off as you're assessing this stuff. Anytime you're dealing with a tax where the debtor was responsible for essentially withholding the funds on behalf of, before they're paying them over to the taxing authority, just like any other trust situation, those taxes are going to be non-dischargeable. Be mindful of the late filed and it was a debate for a long time, although the IRS has since, I think, kind of come out on this, that there was a big debate about late filed tax returns and whether those ever constitute a tax return such that they can be rendered dischargeable. A couple circuits, I don't know, First, Fifth, maybe one other, had basically come out and said, well, a late filed tax return doesn't satisfy your your applicable non-bankruptcy law requirements for a tax return, so it never becomes a tax return that's filed, and as such, any resulting liability is never dischargeable. That's obviously a very onerous interpretation, and it does apply in certain circuits, and there are in those circuits, it's a big issue for state taxes. But the IRS, somewhere in my slides, we'll get to it. The IRS has come out and essentially refuted that position, even though they would benefit from it, as it's a more aggressive interpretation, would not discharge many more taxes. The IRS does not endorse that position, and if they follow the 2-year rule, if a tax return is late but has been filed for at least 2 years pre-petition under 523, you're gonna be fine with respect to non-dischargeability. Of course, fraud down here at the bottom, that is very intuitive. Any fraud-related claims, you're gonna have problems under the bankruptcy code discharging that debt. So the next thing I kind of go through is well, all right, I've evaluated some of the non-dischargeability implications and priority implications. I'm trying to figure out whether a 13 or a 7 meets this client's needs. Well, generally that decision is going to be driven by non-tax factors. The very advantageous super discharge provisions have largely gone away with BAPSIPA. Previously, Chapter 13 provided a lot more discharge power with respect to income taxes. Now it does not. The only exception left there is non-pecuniary loss penalties are dischargeable regardless of the year they're associated with. So that could provide an upside in certain cases, maybe major, depending on the circumstances. Just be mindful that's your only difference between your 7 and your 13 discharge in terms of dischargeability of debts is 523A7 because it does not carry over into 1328A2 like the other provisions of 523 do. Of course, the top of mind with all Chapter 13s is feasibility. In this respect, it's always about the amount of the priority. You got to assess that, what it falls into priority classification under 507 to make sure you have, I got a typo here, to make sure you have a feasible plan. Obviously you've got a 60-month plan term to work with, and ensuring that a debtor can satisfy the whatever falls into that priority class. Now, I think the code provides for express consent of a creditor to overcome that requirement. I personally haven't had a whole lot of success in getting the IRS to take a look at these individually and waive full payment of the. It's happened, but I wouldn't bank on it, that's for sure. You also have to look at if there's liens, whether the debtor can satisfy the secured claims. Now, that's going to be based on the value of the unencumbered assets or the equity over and above liens in all of their assets, personal and real property. Note that this does not include available exemptions, so you leave the exemptions out of the analysis. Assets less the liens, and that's what the debtors are going to need to satisfy if they're going to make a Chapter 13 work. It's tricky. Sometimes you get a debtor that needs a 13 for a mortgage or a car issue, and it's looking shaky from a feasibility perspective because of a tax lien or the amount of priority debt. You can file them if you're going to file them and seek consent to less than a full repayment with the IRS. There's some other creative things that you can try to do, but trying to seek consent from the service is probably your best bet. There's the bottom line is you have to be able to satisfy the value of the assets, and that can become tricky sometimes, in which case, and of course there's a lien slide later, but your lien is going to ride through the bankruptcy. We'll get to that though. I just mentioned again here that in 13, the non-pecuniary loss penalties are just dischargeable regardless of recency. So that's a key thing to keep in mind here, the benefit of a Chapter 13. This slide just goes into what is a tax return. Obviously, we could spend a day on this. It's painfully nuanced, and there are cases that get into splitting hairs under certain circumstances about what does not constitute a tax return. You're obviously not going to get into this with a client, probably at a consultation, where the service is trying to distinguish something that was filed as not a tax return. But just there's case law out there that defines it. And of course, why that's important is you're never into the dischargeability realm if it is not a tax return. So that's why that's an important consideration. Really important, I find, is tolling considerations, sometimes hiding or undisclosed, more importantly, by a client, because they're not aware, of course, of the the tolling, importance of tolling or the application of tolling. Just be mindful of all of your various tolling requirements and when tolling kicks in. One of the hidden ones, obviously, if they've had a prior bankruptcy, that kind of speaks to you. You see it right away. Some of the ones that that's going to toll your 507 guidelines. A pending offer and compromise is going to toll your 240-day assessment rule. A request for a collection due process hearing tolls the 3-year rule and the 240, plus it adds 90 days. So that's going to be clear from a transcript. So if you have those transcripts in hand and your client is telling you when they filed their return and what year they're for, and they're telling you, well, I don't know, I might have disputed or appealed or get the transcripts, you have a better idea. A day can matter. You could blow it, frankly, on behalf of a client if you're dealing with a case where you have a little flexibility in the timing. You're not mindful of a tolling event that took place. So just, be mindful that that stuff exists, notwithstanding your 2-year, your 3-year, your 240. Well, now you have to think about tolling and whether there was a due process appeal, anything. I think of it in my own mind as, was the service precluded from collecting in any respect? And if they were, whether it bankruptcy or appeal or anything, you really have to be thinking about the tolling implications and what that does and how it affects whether that debt may be dischargeable, and ultimately the timing of the filing of your bankruptcy to most advantageously discharge as much as possible. And back to the feasibility, these are all things you run into a case where you run into a feasibility problem that simply cannot satisfy the lien value or the priority debts. Top of mind has to be a non-bankruptcy professional. We'll call him Terry here. He not necessarily non-bankruptcy, but a tax specialist can look at that stuff for you to give your client an idea of what's going to be awaiting them if they're unable to file a bankruptcy, or more importantly, just as importantly, at the end of after their case is discharged. I know Terry does a lot of representations where they resolve they file a Chapter 7 and resolve what they can, and then sort of tie it up with a bow with a non-bankruptcy resolution based on anything that could not be discharged with the bankruptcy. So tax liens, we touched a little bit on this. Note that again, that lien is going to attach to personal and real property, notwithstanding exemptions. Of course, if there's a mortgage against it that's higher priority, that would be reduced out. And the lien is going to ride through the bankruptcy and be recoverable on the other side, unless you use a Chapter 13 to strip or cram or just pay a lien interest. So that might be a consideration when Chapter makes sense, is if you can effectively resolve a lien. If a client is interested in, and I hope Terry can talk on this at some point, where I don't know how aggressively the service is enforcing their liens post discharge. Terry, do you have any insight on that?
Well, for real property, they're not enforcing them except if there's going to be a closing or a refinancing. For other types of property, with the pandemic, there's virtually no enforcement going on right now. But if it's something that's very simple, where they can simply issue a levy, that's happening. Okay.
So be mindful that the debt may be discharged, but the in rem rights as to the liened property ride through the bankruptcy if not addressed. This is one of my pet peeves that I'm always looking at, because it's happened to me before. If you have a lien, you need to be immediately conscious of whether the debt underlying the lien is non-dischargeable or has some non-dischargeability implications, because to me that's going to drive how you approach that lien, especially in a Chapter 13 context. The worst case scenario is cramming or stripping a lien in a Chapter 13 plan, thus freeing. You've got a plan that's producing some decent recovery for your creditor classes, and you strip or cram, thus freeing up money that doesn't go toward the IRS and gets redistributed pro rata to the general unsecured and, more importantly, dischargeable creditor class, while the IRS stands in line with everybody get to receive some share of this distribution, only to collect on their non-dischargeable claim later. So great, you resolved the lien interest, but the non-dischargeable debt underlying that lien is going to survive. So be mindful of that, so you can direct more money and choose your treatment wisely to flow as much money as possible. That's the whole idea here. Identifying ways to pay the IRS as much as possible, especially at the expense of a general unsecured dischargeable creditor pool. You want to pay them as much as possible on anything that's dischargeable. So that's a big one for me. I've been kind of caught up on it a few times where you're cramming and not realizing or understanding that there's a hidden non-dischargeability implication. This stuff can keep you up at night if you're not doing your due diligence, because there really are endless implications and moving parts and nuances that you got to get a handle on. And more importantly, have your clients acknowledge if you're working with imperfect information, or frankly, even if you're not, they should be signing written acknowledgments about their understanding about that what is and what may or may not be dischargeable. That's, paper these files, not just for liability. You want your clients to have realistic expectations and get what they're paying for. And so just being out front of those issues helps eliminate a disappointed client down the line. Now, if you have a lien that does ride through a bankruptcy, Chapter 7, let's say, I think Terry, is the service negotiating the release of those liens post-discharge? Presumably that they recognize that that maybe some of the, that's actually something that I'm sorry to put you on the spot, but maybe you don't know, maybe you do. If part of the debt that underlies a lien is discharged, but part of it is not, are they releasing that and re-recording based on just the non-discharged debts, or is that lien just going to remain?
The lien's going to remain.
Okay.
You can file an application for discharge of lien, and they will usually not do that unless they have received full payment or agreed to something less than full payment. Obviously, if you use an offer and compromise, then there's going to be a release of the lien, not a discharge. But no, they are not going to modify their lien to the to only cover the non-discharge liability.
Okay, great. Now although that begs the question, if you get to a closing, oh no, I guess if the lien's riding through, so okay, you answered most of it, then I figured out the rest of it there. Okay, thanks, Terry. The interest and penalties is always an important consideration. There's a bunch of moving parts and rules there too. To me, these are important with respect to setting your client expectations. Your dischargeability of pre-petition interest follows the dischargeability of the underlying tax itself. Interestingly, your non-pecuniary loss penalties, as long as they relate to it, or meet the 3-year rule, are going to be dischargeable under Chapter 7. So that can provide a nice benefit, and in Chapter 13 as well. As we mentioned before, they don't need to meet the 3-year rule for Chapter 13. But there's an interest. Now, the IRS is inherently and always perpetually aggressive about enforcing rights to collect as much as possible, especially when it gets into the fraud stuff. So this is an interesting exception where a civil fraud penalty would be dischargeable. I mentioned this unemployment case, which many of us are familiar with because it's a Michigan case, a couple of Michigan cases dealing with Michigan UIA. And I think the rationale of that case can probably be extended if the taxing authority wants to argue that, look, yes, it's a penalty, but that doesn't mean we're stuck with A7 that would discharge us. We still have our general fraud provision of 523A2. That's what the Andrews case says. And I don't know if there's any case law development on this or they push that, but I think it's something you mentioned to a client. To me, anytime there's fraud mentioned, there's any suggestion of fraud, you have to be out in front of that with your client and advising them that there's a potential that's non-dischargeable. So that's something to watch, maybe a consideration, maybe something to be mindful of, whether that they'll try to extend the rationale of Andrews to that context. Post-petition interest that accrues, this is important. Your client is paying a priority claim. It's priority and it's dischargeable, of course, or I'm sorry, priority and non-dischargeable, and they're paying that claim. Post-petition, the plan is not going to generally account for interest on that claim, yet it's accruing and remains collectible post-discharge. So your clients need to be aware of that. That's a huge client disclosure, written acknowledgement that they understand that when they come out, I shouldn't say no, very few tax cases are going to come out the other side with a perfect bow on them. Your client should understand that and sign a kind of a plain English acknowledgement to that effect. That's a big component of that is post-petition interest. To me, for me personally, it helps to evaluate priority and non-dischargeability separately. We have a tendency, I for years couldn't get over this tie-in and idea that they were the one and the same, but you know, the easiest way to put it is all priority taxes are non-dischargeable, but not all non-dischargeable taxes are priority. And this can cause a major problem, kind of like I mentioned with the lien, the cram down of a lien where you're leaving this money undispersed to a non-dischargeable claim. Same can happen in this context where you have a debt that is non-priority. I gave an example there. It doesn't qualify as a priority claim, yet it fails the 2-year rule of 523, so it's non-dischargeable. These are tricky because the claim will get filed by the taxing authority and it will characterize it and classify it as a just a general unsecured claim. It will not be a priority claim. And if you're only thinking about priority, then when you see the claim, oh, it's not priority, great. Sometimes the natural assumption is that it's dischargeable because it's not priority. Well, that's not the case. You still have a non-dischargeability implication there that you have to have identified previously, or recognize it at the time. And your client needs to understand that he's paying all his priority debt, paying the priority claim, but there is this general unsecured claim hidden in this claim of the IRS that's going to survive your discharge. Now, where the pitfall is missing the issue and missing an opportunity to file the case advantageously from a timing perspective to make it a priority debt. You want it to be priority. It's going to be dischargeable already. We know that. Now, of course, if you can wait out all the timelines and render it non-dischargeable, great. If you can't, and you assume it's going to be non-dischargeable, then it's best to A, identify it, but B, try to treat it. Time the case so you can treat it as a priority claim, and thus tie it up versus leave it as a because you could have an issue like with taxes where you have all this money flowing out to this general unsecured creditor pool, split up by all, and the IRS is left hanging to collect their money later, when if timed differently, you could flow the majority of the money toward their what is strategically a priority claim, thus resolving most of it. Wow, that's pretty good timing. I didn't even mean that. It's about halfway through and I've got a kind of a takeaway screen here. And then I'll let Terry take the baton. And I don't even need to go through the takeaways, but I will quickly. So the income taxes are not consumer debt. Be mindful of that and the reasons why that's important. Be really mindful of these non-priority yet non-dischargeable debts. The IRS is not going to be filing an adversary. They don't need to. So you're not going to be made aware that they're lurking. You got to be able to identify those issues through active engagement, looking at the transcripts, calling the IRS if there's any questions after you get those claims in Chapter 13. Before stripping or cramming a lien, really be mindful of the potential non-dischargeability implications with respect to the debt that underlies that lien. And you may be able to strategically plan based on whether those considerations exist or don't exist. Order your tax return transcripts and account transcripts to get a good comprehensive understanding of the timelines, what was done when, what this client's history with the IRS looks like. Tolling implications, back up a few slides. Those are critical and several. So keep those in mind as you're evaluating tax issues. And lastly, most importantly, cover your butts. You know, have a good written acknowledgement that it's effective for expectations. It's important for liability. Just have your clients understand what the Chapter 7 or Chapter 13 is going to accomplish for them. Discuss it with them, have them sign a written acknowledgement, and then give them Terry's phone number. So with that, I'm going to wrap on the bankruptcy solutions, and I'm going to stop we practiced this 7 times yesterday. I know how to do this. I'm going to stop the screen share, and Terry's going to take over from here.
Okay, let me get to the screen share. Can everybody see?
Yep, got it, Terry.
All right. Chris, you must have done a fantastic job because nobody sent in one chat comment. So you didn't say anything that was controverted or anything that was inaccurate. So that's a goal that not many people reach.
Or interesting maybe too, though. That's the other problem.
Well, see, that's glass half full. We got to say positive here. I want to pick up for where Chris left off. After a bankruptcy has taken place, or it's maybe determined that a bankruptcy is not the best course of action for somebody that has tax issues, well, where do they go from there? Say they've got non-dischargeable debt, or maybe they didn't qualify for a bankruptcy for various reasons, or they got into a bankruptcy and it was dismissed. What's their next resolution, their non-bankruptcy solution? Well, there's actually 3. The first is to look at a currently non-collectible status. And that really comes down to somebody that doesn't have a current ability to pay anything on the liabilities. And if they've gone through a bankruptcy practitioner and had the schedules prepared, a tax practitioner can take a look at those and not have to reinvent the wheel and see whether or not they show that the person has an ability to pay. If they don't have an ability to pay, the request can be made of the Internal Revenue Service by simply taking the last bill or last series of bills that came in from the Internal Revenue Service and responding with a request to have the account put in CNC status, currently not collectible status. Surprisingly, that happens. And when it does, they'll put it in a CNC status, usually for at least 12 months, just to glance, just to see if after 12 months, they'll have had a couple of returns come in, and that will give them a chance to see whether the person's income has changed. Now, if they don't qualify, if the taxpayer doesn't qualify for a currently not collectible status, then they would move into looking at an installment agreement. And an installment agreement normally looks at trying to resolve, it looks like it's trying to Okay. Chris, can you hear me? And you can see this?
Yep, we're back.
Okay, great. Okay. So if the installment agreement, they're looking at a 60-month payout to pay off the liabilities. If sometimes you can put a stair-step installment agreement in place where you can ask for at least an interim period of 12 months or 24 months at one level with anticipation that there's going to be an ability to pay a higher amount later on. And then you would basically make that proposal, and they will not set it, they usually will not set it up for the full 60-month period in a stair step, but they will have a payment agreement that provides for payments, say for 24 months at a certain level. And then that installment agreement will expire. And at that point, you'll submit additional information that will allow for a higher payment amount after the 24 months has expired. The goal still being to resolve the liability within 60 months. That is something that's done quite often. And that's situations where the person does have sufficient income. And when they took a look, when the service looks at the person's income and their assets, and they would use a collection information statement called a 433F, and that would allow them to full pay the liability at some point. The stair-step installment agreement can be used. Now, not everybody has the ability to full pay their liability, the outstanding non-discharged tax in full. And that's when you start moving into an offer and compromise. An offer and compromise is an agreement that can only be entered into after a determination is made that the person cannot pay the full amount. And an offer and compromise can be sometimes entered into after an installment agreement gets to the end of the first period of a stair-step installment, where it turns out the person's anticipation of having a higher ability to pay just didn't pan out after 24 months. It can be reviewed after the person's been in currently not collectible status for a period of time, or if the person just doesn't have the ability to full pay, as soon as they come out of the bankruptcy, you can look at an offer and compromise as a way to resolve those taxes. That is a good time to seriously, especially if the person's come out of a Chapter 7, that's a good time to seriously look at putting together an offer and compromise. The reason is all the work that's been done to prepare the bankruptcy, all the due diligence that Chris has done, making sure that he's got all the assets, he's got all the liabilities. All of that is currently stated in a very clear form, which can then be downloaded into a collection information statement called a 433A OIC, which is an Internal Revenue Service statement. And it'll all be fresh, it'll all be pertinent, and you don't have to reinvent the wheel, which saves the taxpayers a lot of money and a lot of time. We all know that it takes a lot of effort for many taxpayers to supply information to allow you to fill out those schedules. And as time goes by, from after they've filled out the schedules for the bankruptcy, things are going to change. They're going to maybe not be as diligent about keeping the records as they were when they gave you everything to prepare the bankruptcy schedules. So a good time to seriously consider an offer and compromise is immediately after the bankruptcy. Now, it can't be filed while the bankruptcy's still open, but it can be filed as soon as the bankruptcy has been closed. In fact, oftentimes when the taxpayers start receiving billing notices, once the automatic stay has expired, they will immediately start looking for some way to try to deal with the tax liabilities. And one thing to at least give them a game plan is to approach the possibility of an offer and compromise. If not, then looking at possibly a short-term interim installment agreement. For offers and compromise, again, it's for people that are unable to pay their tax account in a lump sum or through installment agreement in full. And they've looked at other ways to try to resolve those liabilities. Chris had mentioned the difficulties if a person has had allegations of fraud or criminal liability. Well, that is a policy problem for offers and compromise also. But I'd like to give you one example that we had, and maybe it eliminates some of the concerns that an offer and compromise can never be used when there has been a criminal tax assessment. There was a taxpayer that was a member of the Michigan militia. This is in the late 90s when they were quite active, and it appears that they're becoming active again. And that person and family members and other business people in that community decided they did not need to file tax returns and they didn't need to pay tax. Internal Revenue Service disagreed with them and ended up investigating and criminally prosecuting them, and they ended up with prison terms. Now, when the service determined that they were going to prosecute and determine the amount of tax liability, they used all of the income from any records that they could obtain, whether it was from cash hoard or from bank statements or interviews with people that they were doing business with. They were not as diligent in trying to come up with expenses that would offset some of those receipts. And so the result was that they had very large tax assessments against them. The person that we worked with when he left federal facilities became employed, had a pretty good job, had an engineering background, and was interested in trying to resolve the tax liabilities. Tried to get into an installment agreement, but the amount that was required was impossible to satisfy the debt. So just an interim installment agreement was entered into, and then we pursued an offer and compromise. The offer and compromise was allowed to be processed, and it was put in abeyance for quite a long period of time. And we never received a reason why it was held in abeyance, but our speculation was that the service was going to see whether or not this person stayed in compliance with their taxes, whether they filed, whether they paid, and whether they were back doing things that the normal taxpayer is supposed to do. The result was that the taxpayer did that, and the service eventually, over 18 months, came back and said, well, now we need updated information because all the information that was submitted previously is stale. And once that was submitted, the offer and compromise was processed within 6 months, and the person received their acceptance. So it is possible to obtain an offer and compromise on tax debt when there was fraud or criminal liability, but it's a longer process. You don't have to go through as many hoops if the person hasn't had that, but it is possible, and it's not going to be accepted in all circumstances. It probably depends on how egregious. But given what we've seen here around the news lately, I think there's going to be probably some more interest in looking at people that maybe haven't filed taxes and maybe looking to pursue them. And the result might be that we're going to have some more people that are in the same situation where they might have a criminal tax liability, but might need, to the extent that they are getting back into compliance. That is something that they can do as long as they're willing to work hard and to get back into following the tax laws. Now, what I just described was a doubt as to collectability basis for an offer and compromise. There's also doubt as to liability, and doubt as to liability really pertains to whether the person has been assessed a tax improperly. Now, back when tax shelters were rather popular, there were a lot of tax shelter penalty cases out there and a lot of large penalties that were asserted. There are also, responsible officer penalties that are asserted, and many times the taxpayer, especially on the officer, responsible officer cases, just never responded to the inquiries that were coming from the service because they were losing their business, trying to deal with the wind down and disposition of assets. And when they got that notice from the service that they were conducting a investigation as far as trust fund liabilities, that just got put on a shelf and they never responded. So there are ways that you can use doubt as to liability for purposes of getting an offer and compromise. It's not that common, but it does happen. The third basis is that the offer promotes effective tax administration. And that really, it's talking about economic hardship and other special circumstances. And we have had one of those that we've been able to put through, and it had to do with a person that had a severely injured child. It was an accident that occurred. The anticipation, they had incurred very large medical bills. We're going to continue to incur large medical bills in the foreseeable future, potentially having a long-term care expense issue. It took a lot of documentation, including a lot of medical records, and the service did agree to a tax administration offer and compromise, even though the financials for the taxpayers showed that there was an ability to full pay. It wasn't immediate full pay, by the way. It was.
Can I interrupt for a second?
Yes.
With those three options, when you submit a request, are you electing one of those, or generally will you throw it all at the wall and see what sticks? How does that work?
You elect one. You determine which is appropriate. I think it minimizes all of them if you checked all three boxes for an offer and compromise. Now, there are times when you would look to doubt as to liability and doubt as to collectability. For example, a trust fund situation where a person's assessed a very large trust fund from employment taxes, and there's just no way that person individually can pay it. But you almost have to choose which of those two you're going to want to pursue, because they go to different departments, Chris. One goes to the examination division, which is doubt as to liability, and the other one goes to the collection offer and compromise division. And that's usually where you prefer to be.
Okay.
Okay. There are three ways to fund an offer and compromise. There's a lump sum cash offer, which is a misnomer because you don't actually pay a lump sum. you come up with a cash sum that the taxpayer can afford to pay or anticipates they'll be able to afford to pay if the offer is accepted. And once they receive their acceptance letter, they have 5 months to pay those payments in. And if they fail to make the payments, then the offer is rejected, and whatever's been received as far as their initial down payment and whatever payments they're able to make is kept. It's not going to be returned, but the offer would not be completed, and the balance of the debt won't be extinguished. That's the lump sum offer. That offer is the preferred method because that looks at 12 months of income over expenses for the income portion of the offer. And I'll explain in just a minute. There's actually two portions to an offer in compromise. There's the equity portion, and then there's the income, future income portion. The second way to fund an offer in compromise is short-term periodic payment. And that looks at payment over a 24-month period for resolving the liability. Now, not resolving the entire liability, it's just whatever the amount is that the taxpayer is proposing to pay would be paid over a 24-month period. The disadvantage of that payment method is that, first of all, on the income portion of an offer in compromise, it's looking at 24 months of income over expenses versus the lump sum is looking at 12 months of income over expenses. A second shortfall of the short-term periodic payment is that the taxpayer has to begin making payments when they submit the offer in compromise. So from every month after that, they continue to make payments. Where with the lump sum, when they filed the offer in compromise and they filed their down payment and their offer fee, they cease making payments until the offer has been accepted. So there's quite a lag, and that gives them time to really kind of catch their breath, which you don't have with a short-term periodic payment. The third, and I've never used this, but it's out there, is a deferred periodic payment. And there, the offer is paid within 25 months or longer, but within the 10-year collection statute. And that, whenever you have somebody that needs an offer in compromise, anything that gets beyond a couple of years is really dangerous, because life happens, and they may not be able to meet those payments on a longer term basis. You want to try to have it, I think, and for the people that we work with, we try to recommend that they focus on a lump sum cash offer, if at all possible, if there's any way to come up with the funds. So I thought one way to demonstrate how an offer works is maybe to show an example. And I picked somebody and named him Joe Chef. And Joe was a chef at a restaurant. The restaurant closed because of COVID. Prior to working at this restaurant, he had his own restaurant, which was not successful, and he ended up with a lot of trust fund liabilities from that. And from what I heard President-elect Biden say last night, 400,000 businesses have closed in the United States during the pandemic, and I don't anticipate that slowing down. So maybe Joe's situation is something that's more realistic than not. Well, in Joe's situation, we had to get a determination of his ability to pay. They call it reasonable collection potential. And as I mentioned, there's two components. The first is the net equity and assets. That's almost like looking at a snapshot of what he has for assets to pay towards the taxes. And the second is income, anticipated income potential for purposes of funding an offer. So in Joe's situation, he's got to he's got a wife, Doris, and he's got a checking account at Harris Bank, $3,000 in the checking account. Half of that's owned, it's deemed to be owned by Doris. So we've got $1,500 exemption. So the net equity on that account is $1,500. Obviously, if Doris can show that she's put all the money in the account and not Joe, that could be pared down, but it's not worth doing it for $3,000, but it might be worth doing if the amount that was in that checking account was $20,000. But in our situation here, you've got $1,500 equity. They have a residence, $175,000 fair market value. And what is usually used for fair market value is you just take twice SEV, and that number is accepted by the tax authorities for fair market value. The services, both Internal Revenue Service and State of Michigan, realize that they're bad at selling assets, so they discount the value of the asset by 20%. So you're looking at 80% of the total value of the residence. That's a quick sale value of 140. Joe's interest in it, says he holds it with Doris, is 70,000, and so that's his equity. Doris has a car. That value is attributed to her, and no equity goes in Joe's column on the right. Joe's got a car. Again, you discount it for purposes of a quick sale. He's got a debt against the car of 15,000, so his equity is 1,000. They've got a CDU, same situation. You discount it. Each of them has 1/2. One thing that's got to be really focused on here is that the tax authorities, when they're looking at an offer and compromise, they're doing a title search and they're doing a UCC search, and they are looking to see if there are any assets that are in the name or in which the taxpayer has an interest that do not show up on their asset listing for an offer and compromise. If they find something, they will decline the offer and potentially, and I've seen this, will potentially refer it for a criminal prosecution. So you got to make sure that the taxpayer is listing every single asset, especially anything that is of record. Even if an asset, and we've seen this before, even an asset where the taxpayer has a 1/5 interest together with 4 siblings. If that, in one case, one of the siblings had a life estate, so that even decreases the value of that asset even further. You have to make sure that that is listed and that that's accounted for. Now, it could be that the value of it, because of all of the encumbrances, is virtually zero, but make sure that that asset is listed and is dealt with. We've got here in Joe's situation, he's got an IRA. Actually, that's his wife's IRA, so he doesn't have any equity in it. If it was Joe's IRA, you would discount it by the tax that must be paid once he cashes in that IRA. And if Joe is under the age limit, he would have to pay a penalty. You'd discount it for the value of that penalty also. So that is that's the equity side, and based on that, Joe's got equity for reasonable collection potential of $72,900. You now get into the future income portion of an offer and compromise. Joe is working at a grocery store now and making $480 a month. His wife is the major income earner, and Joe's also got a small pension. So the total income of the household is $6,920. Now you take the expenses for the household and you determine his percentage of the expenses, basically his ratio of his income versus the income of the entire household, and it's 13%. And so he gets the benefit of 13% of the expenses. And when you're doing the calculation, you back out Doris's income because that's not his, it's hers. So based upon that, you've got $6,920 of total income and $6,859 of expenses. So there's a few dollars per month. I think it's $61 a month that you have to take a look at contributing towards an offer and compromise. Some of the numbers that we've got in here for legal fees, let me just explain. Legal fees are allowable if the fees are being incurred to prepare or resolve the taxes, prepare an offer and compromise. They will, if the case is a little bit more difficult than Joe's, legal fees can go up to $250. We've seen them at $250 to $300 per month. That have been allowable, but was used in this case was, or this sample was 150. So here's how it works to determine what's his ability to pay. You take a look at his equity and assets, you take a look at his future income, and it looks like he's got ability to pay $73,632. Now, here comes the hard part. How does he pay that? How does he come up with it? Well, he had $70,000 of equity in his house. So if he's able to find someone that will loan the funds to pull the equity out of the house, he could pay the bulk of the offer and compromise if it was accepted. He could also borrow it from his wife or from a family member, if that's possible. And there are actually a couple of banks in the area that are interested in loaning on offers and compromise. Obviously, it's got to be an asset-based loan. The rates are not going to be in the 3% and 4% range, but it's a good way to resolve the outstanding tax liability, get rid of tax liens, and let the taxpayer, let Joe have a fresh start. Now, in order to accomplish this, once Joe determines, all right, I think I can come up with a $73,632, what he has to do is he has to come up with 20%, the offer and compromise needs to be prepared. Use the form 656, which is the offer form. Got to fill out a 433A OIC, which is a collection information statement for an offer. Luckily, Joe doesn't have a business any longer. The business was lost in the last recession. But if he still had a business, he would have to fill out a collection information statement, a 433B for the business, because they take all of those assets into account and to look to see whether there's an ability to pay from a ongoing business or from any other source that he might have a relationship to. Once it's determined that he's going to go forward, he has to come up with 20% of the $73,000. He's got to have a separate check for $205. He submits submits those funds together with the offer and compromise. He has to submit copies of titles to any vehicles, copies of deeds to any property, 3 months of checking account statements, any kind of car loan statements. In this case, he had a loan against the car. He's got to have a statement on the car loan. In this case, too, he had life insurance policy. It was not a whole life policy, but still he was taking that as an expense. So he's got to include that and submits that to the Internal Revenue Service. It goes to Holtzville, and it will take them about 90 days to determine whether that offer is processable. In order to be processable, Joe has to be completely up to date on all of his filings of tax returns. He has to be up to date on his current tax deposits. He's working at a grocery store, so he's got a W-2. So there shouldn't be a problem with deposits. But if he was a sole proprietor or if he was working with a business with a draw, he would have to be able to demonstrate that he's been making his quarterly payments. He has to be in compliance. We recommend for at least the last 3 quarters, because if he's not in compliance or he's getting behind on the prior tax return, so once he files the offer, the new tax return hits and there's a liability, it's going to default the offer and he has to start over again. And that's not anything that anybody looks forward to after doing all the work of putting together an offer and compromise. The offer, when it's deemed to be processable, they'll put a hold on any collection on his accounts. He has to be sure that he's filing tax returns and staying current on all payments while the offer is being processed. Again, if he doesn't timely file a tax return or doesn't file an extension to file a late tax return, the offer will be defaulted, and that'll be the end of processing potentially large forgiveness of a large amount of liability. Since he's an individual wage earner, it would take about 6 to 18 months to process the offer. We've seen a slowdown from that during COVID. Within the last 3 months, the offer specialists have started to pick up their files and move forward and make progress on their offers. For about a 6-month period, they were not allowed in their office, and so they didn't have access to their files. And some of them did not have laptops, so they had very difficult time working remotely. But now there's a schedule where the offer specialists are able to go into their offices normally once a week for 2 hours, only one person in at a time to stop the spread of COVID. And so there's been some progress made over the last 3 months as far as processing offers. If Joe still had the business, go ahead, Chris.
Sorry, we're starting to run into the next session's time, and there's no kind of buffer. So if you got something in conclusion, sorry about that. We'll try to put a bow on it and pass the baton here to the next session.
Okay, great. Just a couple points. Michigan now has an offer and compromise program. It started in January of 15. Basically, the best way to use the Michigan program is to run a federal offer and compromise first. Usually, if a person has a Michigan liability, they probably have a federal liability. And once they get an acceptance from Internal Revenue Service, then they can submit their offer for the state and ask for the same level of forgiveness as they receive from the state. If the state will process those and quite quickly. If you don't have the ability to go with an IRS offer acceptance letter, which I have on the screen right now, then you have to go through the state program, and it takes extensive amount of time for that. And I will stop there.
Great, thank you, Terry.
Yep.
Thank you, Chris. Thank you, Terry. I really appreciate it, guys. I thought it was fantastic. Hope everybody's enjoying it so far. I'm sure they are. Next up is the case law update. I think I saw everybody logged in. We have Judge Dales, Judge Boyd, and Harley Alexander. Thanks, guys. I'll let you take it away.
All right. Good afternoon, everyone. Welcome to the case law update. I'm Scott Dales, a bankruptcy judge here in the Western District. With me on the screen is Judge Jim Boyd, also from the Western District, and a practitioner making her debut Debtors Bar seminar, Harley Alexander from Russell and Tag in Grand Rapids. We're going to talk a little bit about a couple of recent cases, and We hope to make this somewhat participatory. Unfortunately, because the number of people, if you want to participate, do it through the chat function. And then I think Shelley's going to monitor the chat function and raise whatever questions that there are that we can try to address. It's about as participatory as we can be, unfortunately. Jim, you want to get started?
Yeah, and Shelley is on. And again, if you do have any questions, use the chat feature. Shelley will monitor and try to interrupt us when it's appropriate and maybe even when it's not. Yeah, we're ready to go and we'll move quickly here. First case we want to talk about a little bit is the one that you probably saw yesterday, City of Chicago versus Fulton. So this is a Supreme Court case from yesterday. And I think we've all heard of it over the years as it's gone up through the circuits. And just briefly, pre-bankruptcy, you had the City of Chicago that impounded a whole bunch of vehicles for failure to pay outstanding parking tickets. Debtors then filed Chapter 13 petitions. There were multiple debtors, multiple cases. And the city refused to turn over the vehicles to the debtors, claiming that it needed to maintain possession of those in order to continue perfection. Bankruptcy court ultimately held that the city violated the stay by exercising control over property of the estate simply by retaining possession of them. And the Seventh Circuit affirmed. Now that was contra to the 10th and the DC circuits, which had similar cases where it said the secured creditor did not have an automatic obligation under Section 362 to return the vehicles to the debtors upon the filing, because it was not an act of to exercise control over property. So what the Supreme Court yesterday said, they went with the 10th and the DC circuits, reverse the Seventh Circuit. Merely retaining possession of estate property does not violate the stay. 362A3 acts as a stay of any act to obtain possession of property of the estate or of property of the estate or to exercise control over property of the estate. This language suggests that 362 applies to any affirmative act that would alter the status quo. Something more than merely retaining power is required to violate this provision. Basically, the court said if 362A3 covered mere possession, it would essentially make Section 542, the turnover provision, superfluous. The court did not delve into how 542 is supposed to operate here. However, in a concurrence, Justice Sotomayor, I think appropriately said, there's a lot of practical issues as this is going to create, because if you want to get your car back now, you've got to look at the turnover provisions. And I think most courts say that if you're going to seek turnover from a third party, that requires an adversary proceeding to do so. And in fact, she suggests either the Rules Committee or Congress jump in and do something to try to fix that. Judge Dales, any thoughts about that?
Yeah, I would say to just echo what you said about the requirement of an adversary proceeding. Rule 7001 sub 1 says that a proceeding to recover property other than to compel the debtor under 542 requires an adversary proceeding. Frequently, we see these done by motions, and if the parties on the other side are not objecting to that procedural posture, then we do it by motion under an older decision that Judge Nims had. I would say a couple things that in addition, and that is, if you look at Section 542, that is a provision that really directs the turnover to be made or the property be delivered to the trustee. And so in a Chapter 7 case, the debtor may not have as much luck doing a 542 turnover adversary proceeding, may need to get the trustee involved. In a Chapter 13 case, I think the situation is a little bit different because of Section 1303 that gives the debtor the rights under Section 363 that a trustee would otherwise have, which is a much stronger case for the debtor being basically in the stead of a trustee for 542 purposes. One last thing, and that is, I think you're seeing in this decision a similar, very traditional approach to injunctive relief like we saw in the Taggart versus Lorenzen case on discharge injunctions, where the Supreme Court applied traditional civil contempt principles to the discharge injunction, obviously another bankruptcy statutory injunction Here, I think the Supreme Court again applied traditional injunctive, civil injunctive provisions by saying the stay simply preserves the status quo. We're not going to interpret it as requiring anything affirmative. Harley, you got anything to add?
No, I thought that it was really interesting because I know I've been hearing about this case pretty much my entire legal career, and I thought it was really interesting that the Supreme Court decided to rule differently compared to what we were kind of hearing. So,
Judge Boyd?
Yeah.
I do have a comment and a question from Brian Rookard. Says regarding Fulton, the interesting part of the case is whether or not we need to file a motion to an adversary under section 542, which maybe Judge Dale's just hit on, to have that asset returned. What has been the practice of the judges? Here in Eastern District, it seems like creditor already is adequately protected by our local rules and the filing of a proof of claim. Does this mean the creditor would have no excuse to withhold the property?
Well, I think what the case says is you probably should be filing an adversary proceeding unless the other side, as Judge Dale said, unless the other side doesn't object to that, if you want the property back, and maybe accompanying it with some sort of motion for an injunction to stop anything from happening to it, and maybe to get the car back. I don't know. What do you think, Judge Dales?
I think one of the things that the Supreme Court was reacting to in its decision yesterday was the additional requirements that are in 542. The turnover obligation of 542 is conditioned in a way on the debtor, on the trustee being able to use the property and the property not being something that should be abandoned, essentially. Whereas the prior practice in many districts, including ours, was that the 362(a)(3) obligation was, basically unconditional. If you're holding the property and they file, we pretty much thought that after demand for the return of the property, that was exercising control. I mean, I hate to be obtuse about it, but it seems to me if you put a fence around somebody's car that you repossessed, you're doing that to exercise control. But I'm not on the Supreme Court.
So much for your opinion. So I don't know if that answered the question. Let's keep it moving here, though, if we can. We're going to move a little bit into some Chapter 13 cases dealing with post-confirmation modification. Judge Dales.
So we've identified three fairly recent decisions involving modification under Section 1329. The first one on our slide is the Hakela case. And it actually somewhat ironically didn't start out as a modification, a request to modify the plan. It started out as a motion for a moratorium on plan payments. And I've kind of struggled in the last few months or years even with these moratorium on plan payments, because frequently the way they've been presented is basically a stipulation between the debtor and the trustee, and then the next day it shows up in the order signing program, and people want to have their stipulation or stipulated motion approved. And of course, that presents some issues about due process if we're not following the notice and opportunity process that we typically do, and which allows us to get away with a lot in bankruptcy. And so I sort of have been treating those quickie stipulated motions for moratoria as essentially an agreement that the trustee would not assert the missed payments as a basis for dismissal. In other words, since these motions have pretty much been limited to the notice parties have been limited to the trustee and the debtor, that's how I treated them. I got this Hakela matter, and the debtor's counsel, to her credit, served the motion on all creditors using notice opportunity to object. She was proposing, although I did have some questions about the precise relief, she was proposing a 3-month cessation of payments, and there were no objections, and the order came into my order signing program. Because I did have some of these questions about the what I regarded as perhaps ambiguity in the motion, I set it for a hearing, and we talked at the hearing about whether this was actually a plan amendment and how we should go about addressing the problem that debtors have increasingly, especially after COVID and the quarantine and all the financial disruptions, how we should go about addressing the need that debtors find themselves having for relief from their payment obligations. And the long and short of the HICLA matter is I treated it as I treated the motion as essentially a de facto motion to approve a plan amendment, because what they were seeking was to essentially reduce or extend the time for making payments, which is one of the express provisions in section 1329. The motion was on behalf of one of the three parties that's authorized to make an amendment under 1329. Obviously, the three parties are the debtor, the trustee, or an holder of an unsecured claim. And everyone had notice, and it was appropriate. My questions were answered. And so I treated it as a deemed amendment. I also suggested that going forward, we shy away from motions for moratoria, because there really is no statutory basis for them. And if you're going to try to bind everybody, you might as well do it as a plan amendment. And that was the long and short of the HICLA case. The other two Chapter 13 plan modification decisions that we identified for discussion today are the Williams case. That's my case from September. That's 2020 Westlaw 5753318. And a case, a Judge Shefferly case from the Eastern District, in Ray Ellison 620 BR 594. The facts are different, a little bit different, but the principles are the same. In the Williams case, after the Sixth Circuit issued its decision in Davis versus Helbling earlier in 2020, the debtors moved to modify their plan so that they could start making retirement plan contributions. They proposed to reduce their plan payments and use that money to fund their retirement. Their theory was that now that the Sixth Circuit panel had squarely addressed the disposable income issue involving retirement contributions in favor of debtors, that they wanted to take advantage of that in their Chapter 13 proceeding, where the plan had been confirmed a year or two before. And the trustee objected to that proposal essentially on disposable income grounds, and saying, look, basically the Seaford dicta got it right, and you can't fund your retirement at the expense of your creditors, and et cetera. I had argument on the motion, and at the conclusion of the argument, took the matter under advisement, and I wrote this kind of short little opinion in which I said that, first of all, the Seaford case, which had the dicta that said you can't reduce your disposable income by your contributions, that case arose in the context of original plan confirmation, and so did the Davis case, original plan confirmation. But because we were here on a motion to modify a confirmed plan, and because under section 1327, confirmed plans are binding on the debtor and all interested parties, we had to address the finality problem. In other words, the limitations that section 1327 impose on the debtor's freedom to modify a plan. I've seen a lot of plan modifications that if someone had objected, they probably would have been easily denied or disapproved, to be more accurate, because people are asking for all sorts of things through modifications that are not within the three categories. But in this case, they arguably were asking for a reduction in plan payments, but my accommodation of the finality requirement of section 1327 and reading a Sixth Circuit BAP opinion, among others, in Story versus Pease, in re Story 392 BR 266, led me to say that, listen, if you could have raised the issue at plan confirmation and you didn't raise the issue, then fairly straightforward principles of res judicata or collateral estoppel preclude you from raising the issue in a plan amendment under section 1329. And then, for good measure, I recognizing that I had discretion in the modification context, I said, I'm not comfortable approving the plan modification where the debtors are proposing to pay themselves at the expense of their creditors. I regarded that as inconsistent with equitable principles. Basically found the Seaford dicta persuasive, even in this context, and said that I disapproved the proposed amendment. Basically, they could have raised it before, they didn't, and they were stuck with it in their plan. The Ellison case, go ahead, I'm sorry.
Judge Dales, I'm sorry. I have a question on that may be relative to what you're just talking about right now. If I could throw that out there for you real quick.
Sure.
Modifying plans after the fact. Although Section 1327 binds the debtor, and although it seems that one cannot use 1329 to modify something that could have been dealt with prior to confirmation, what about using Rule 60B to seek relief from the order confirming plan instead? For example, if there was a mistake that was made pre-confirmation.
Yeah, I think that's a potential for addressing mistakes or other matters that come within the context of Rule 60. I don't think it would be universally applicable because there's plenty of case law that says if you made a strategic decision not to challenge something, you're not going to be allowed to call that a mistake for Rule 60B purposes. But I think it's an excellent point. And actually, it's a point that occurred to me when which is probably why I think it's excellent. It's a point that occurred to me when I was reading the Ellison case, which I'll talk about right now. And in that case, Ellison involved a slightly different set of facts, but also a post-confirmation plan amendment, where at confirmation, everybody knew, including the debtors, everybody knew it was a 36-month ACP. The debtors were below income debtors, but their plan proposed to pay creditors over 60 months. And the court confirmed that plan. There was no controversy whatsoever about the 60-month term. You may recall that the statute requires the court to basically to find cause for having a plan term longer than 60 months in this situation, but nobody raised it. And the court confirmed the 60-month plan, even though the debtor was 36-month ACP debtor. When things got a little hairy, I guess, probably related to the COVID disruptions, the debtors filed a plan modification and proposed to make their plan term 36 months on the theory that it shouldn't have been approved at 60 months. There was no finding of cause, and in response to that, of course, the trustee objected, as they frequently do, to try to protect the finality of the confirmation orders and to do their job in seeing the creditors get paid. And Judge Shefferly had a hearing and concluded that the issue of whether there was cause to go for 60 months was something that could have been raised but wasn't, and rejected the modification on that grounds. A couple of points to emphasize, because I know we're trying to keep moving here, from the Ellison decision, which I think is worthwhile reminding people. We have seen in some of the cases the statement that we're not going to approve a modification unless the debtor can show changed circumstances, changed financial circumstances. And Judge Shefferly makes the point, and I think it's a fair one, that there's no requirement for showing changed circumstances as a condition for modification of a plan under 1329. He also said, however, that because the court has discretion whether to modify a plan, that changed circumstances are relevant to the court's exercise of its discretion. So just a little quirky thing I want to point out from Ellison: don't let anybody tell you you have to have changed circumstances, but it's probably a pretty good idea to allege them. Let me also make one final, as long as I'm on my soapbox, one little final point about modifications. Because of this COVID disruptions, financial and other, over the last few months, even though our case filings have been really low, my folks in my chambers, and I think, Jim, you probably could say the same thing, we've been really busy. And a lot of what we've been doing is running around on plan amendments. There have been quite a few plan amendments and quite a few objections to plan amendments. And my only 2 cents that I want to offer is sort of a practice tip, not necessarily case law update. It seems to me that most of our plan amendments which draw objections are resolved in favor of the debtor after the debtor supply the documents that the trustee wants. So I would recommend when you make your plan amendment, you move to amend your plan under 1329, support it with pay stubs, support it with perhaps even a declaration from the debtor, which you can do without a notary under section 1746 of Title 28. Support it with a declaration that says, I lost my job, or my pay got cut, my hours are cut, we're only at 20% or whatever it is. Support your amendment and you could probably avoid objections, because the trustees, it seems to me, and the court, at least me, I'm sure Jim too, and John as well, we've been pretty flexible with amendments during this horrible time, but we need to see the documentation. So you get headed off at the pass, it'd be a lot cheaper. That's it for my 3 cases on modification.
Harley, anything you wanted to add on those cases?
No, I just think like with the COVID-19 pandemic still going on, that we're going to see a lot more of an influx for those plan modifications. And I really liked how Judge Dales kind of broke it down onto how best to resolve the issues, because I know when I first started doing them, I was getting them kicked back because we were missing some information that should have been put in there. So I really like the breakdown of that. And then I think going forward, I know in my experience, as long as I provided the trustee with all that information, they've been okay with it. And I think that's really kind of where we need to go going forward. My only question is, aside from the whole like COVID update or the COVID-19 pandemic going forward, after we hopefully return back to normal, in instances like that, should we keep that going forward, provide documentation to the court, that way they know exactly what's going on, why we need a reduced payment or a moratorium just going forward?
Yeah. I mean, from my perspective, the more information in your pleadings, the better, yes.
I wouldn't disagree with that. I think there's a tendency to get something on file quickly and not have it documented in as much as it should be, and you end up spending more time and more money on it. And I think you owe it to your clients to make the best motion you can for amendment and support it. Just have Exhibit A is the proposed order, Exhibit B is the affidavit, and the affidavit or the declaration from your client can say, I lost my job and I got a new one. Here's a pay stub, and you can see I'm making $200 less a week.
Yeah. And that question you ask, I think, applies to not just these sorts of pleadings, but all pleadings for all practitioners. You'd be surprised at how often we get a proposed order in our order signing program, no objection. So presumably it makes sense. Presumably a Chapter 13 trustee or creditors have reviewed it and it's not objectionable. But when we go back, or at least when I go back and read the pleading, you'd be surprised at how often I just don't understand. And it's a lot of times because there is a deal, the parties use shorthand sometimes, but you need to lay it out in a little bit more detail. I'd also just, one last note on these cases, the question that was asked about Rule 60 and Judge Dale's response, that was a good idea. Certainly in light of 1327 and finality and the limitations of 1329, if you want to modify and it doesn't fit within 1329, it's probably better to approach it on a 60B basis than it is just to throw something at the wall and see if it sticks in terms of something newly invented that you're going to try to fit into a 1329 modification. So, okay, let's keep moving here. We're going to move on to fraudulent conveyances. Harley, you're up on Moyer versus Van Popering.
Yeah, so in this case, it really boiled down to two different deeds. There was a 2002 deed where it was executed and recorded within the same year, and it purported to transfer and convey a property from the defendant to the debtor. And then a 2014 deed, which was recorded in 2017, but executed in 2014. And it purported to convey any interest that the debtor had in the property to the defendant, who was the supposed grantor in the 2002 deed. The debtors filed for Chapter 7 relief in 2005. And then in 2017, the defendant and the undisputed co-owner of the property ended up selling the property to a third party, and it resulted in sale proceeds in excess of $150,000. The trustee wanted to move to pretty much avoid those transfers and get the property and the money back into the estate. And the trustee contended that the bankruptcy estate acquired the debtor's interest in the property under 544A1 and A3, using the trustee's strong arm powers as a hypothetical lien creditor. And he also contended that the debtor's supposed retransfer of the property back to the defendant in 2014 is an unauthorized post-petition transfer, which would be avoidable under 549. Lastly, he contended that he was entitled to receive the proceeds from the sale, as well as any earned rent from the property, which would have made sense, but the court decided that because there was concerns regarding the 2002 deed about whether or not it was even a valid deed. The real concern boiled down to whether it was recorded and whether it was delivered and accepted. Clearly, the 2002 deed was recorded, but the defendant argued he never delivered it to the debtors. And what the court really took notice of was the debtor's 2004 examination, in which they disclaimed any knowledge of it. And I think that really boiled down to why the deed really just wasn't valid, even though it was recorded. And the trustee tried to use the protections of a bona fide purchaser, but he couldn't use those protections because it wasn't a valid deed. And in order to use the protections, it had to have been purchased by another individual. So the court found for the defendant, and the property just wasn't a part of the bankruptcy estate.
Yeah, this was a real interesting fact. You still have this on appeal, Judge Dales?
I wish I was the one handling the appeal, but I handled it at the trial court. If I were handling the appeal, I think I would affirm myself.
Yeah, but you might get it back or no? Or is it over and done?
It's not over and done. I think Andy Gertis may be on the line. Of course, I'm not sure he can talk, but I think it's still on appeal.
Yeah, well, you probably can't either. But it's an interesting case in that I think, as most people here know, I mean, I was a trustee for 25 years. I'd never seen this issue raised before, where you had a grantor arguing that even though the deed had been recorded, it wasn't delivered or accepted by the debtor transferee. And it looked like it went up on summary judgment, and there just wasn't anything in the record to refute the testimony of the grantor about what had happened at that point in time, and because of that, it defeated the trustees. The trustee was not able to invoke his strong arm powers around that. Real interesting issue.
Judge Boyd, Andy Gertis just said, fortunately, Judge Yonker will get the final word.
Oh, Andy, you couldn't resist, could you?
Andy, he asked you, so I'll defend you on that. So, okay.
Thanks,
okay,
Andy.
We'll flip to fears. Almost same facts, little different outcome. Harley?
Yeah, so in this case, it also deals with two different deeds. One was the March deed and the other one was in December, both of the same year. The March deed was signed and it conveyed the home to the debtor and her son, who's the named defendant in the case, as joint tenants with the right of survivorship for $1. This deed was not recorded. In December, after her case was filed, she signed another quitclaim deed that quitclaimed the same property to the defendant, again, only for $1, but this time the deed was recorded. Initially, the trustee had an issue with the debtor's exemptions, but that was resolved. And none of the exemption issues was in relation to the home. And when the debtor's case ended, she received her discharge. A couple months after her case ended, the trustee filed an adversary proceeding to avoid both the March and December deeds. The trustee alleged that the March deed, the debtor did not receive any consideration that the the debtor did not receive any consideration and that the debtor was insolvent at the time that the deed was created and transferred. And then the December deed, the trustee alleged the debtor was unauthorized to even make and sign the deed because their case was still pending. And I thought something that was interesting in this case was the debtor alleged that because the March deed was unrecorded, the trustee's assistant needed the debtor to produce a copy of a recorded deed, because in the Eastern District where this case was, they require both the recorded and unrecorded versions of the deeds. And so the debtor went and signed the December deed and then ended up recording that one to provide to the trustee. The court looked at the 548A1B, that the trustee could avoid a transfer of an interest of the debtor's property if it was made within 2 years before the date of filing the bankruptcy petition, and if the debtor received less than a reasonably equivalent value in exchange for such transfer, and that the debtor was insolvent on the date that such transfer was made. The defendant was unable to refute either of those because there was an issue about the value of the property. He only provided his mother $1 and a promise that he was going to help get caught up on property taxes. The court found that the promise to help was not sufficient enough to equate to equivalent value. And the defendant couldn't dispute that the debtor was insolvent at the time that they made the transfer, because she ended up filing her petition approximately 7 months later. So in this case, the court actually sided with the trustee and allowed the trustee to void the transfers, just because really it boiled down to the deed, even though it wasn't recorded, it was still a valid deed. And because the defendant couldn't dispute the fact that she was insolvent at the time of filing and she was not authorized to make the second deed, the December deed.
So unlike the last case, there was no question of the first deed having been delivered or accepted. So that being the case, the bankruptcy was filed. Trustee wins under the strong arm powers, no question. We're going to do one more. I'm going to jump 2 slides ahead here. United States versus Key. Harley's going to talk a little bit about fraudulent conveyances in the context of the Fair Debt Collection Practices Act. Harley?
Absolutely. So this one is, again, kind of similar to the other two, where we're involving a deed and consideration of it only being $1. So in this case, the defendants had a criminal restitution judgment against them for $350,000 following a conviction on charges of transporting stolen goods. Between September of 2013 and July of 2015, they unlawfully transported stolen goods in interstate commerce in violation of 18 U.S.C. 2314. When they filed their case, their petition for bankruptcy, they already had a warrant to search the house. The U.S. Postal Inspectors executed a warrant back in 2015. And 3 months later, in October, the defendants conveyed her property, which was located in Memphis, to her son for the sum of $1. The defendants in April of 2017 were sentenced to 47 and 30 months of imprisonment due to the convictions that they were facing. After the judgments were entered, the government obtained a statutory lien under 18 U.S.C. 3613C and all property and rights to the property belonging to the defendants. In October of 2017, the U.S. ended up suing the defendants and the defendant's son, who got the home from the conveyance, under the FDCPA, alleging that the Sardis property was fraudulently transferred in violation of 28 U.S.C. 3304. And what U.S.C. 3304 boils down to is the badges of frauds. And they typically look at 11 factors, but the district court found 5 factors that apply to this property transfer. One being the transfer was made to an insider. It was made from the debtor to her son. The transfer occurred shortly after the defendant learned that she was threatened by a criminal indictment based on the postal inspector's search of the defendant's home. The defendant clearly didn't receive reasonable equivalent value in return for the transfer because the defendant's son only gave her $1 in consideration. The defendant was insolvent at the time of the transfer, and the transfer occurred shortly before the defendant incurred a substantial restitution debt by the filing of the criminal indictment. Because the defendants weren't able to dispute that it was clearly, the transfer was clearly made to hinder and delay the creditors, the court ruled by summary judgment in favor for the government, and the transfer was avoided.
Okay. And let's go back to one of my favorite cases, Harley, Wigger.
Yeah, so in this case, it involved a suit against the treasurer of the state of Michigan and the defendant. The treasurer brought an action against the defendant in state court in 2015 under the State Correctional Facility Reimbursement Act to recover the state's cost for incarcerating the defendant. In December of 2015, the Muskegon County Circuit Court determined that the state was entitled to recover some of its costs from defendant's individual retirement accounts and from proceeds of a judgment that the defendant had obtained against his son. In 2017, the defendant ended up filing a Chapter 7 bankruptcy. The defendant, during his bankruptcy proceeding, brought an adversary action against the Michigan State Treasurer to discharge the debts and liens against him and his property. The defendant claimed that the interest in the IRA and the judgment were exempt under 11 U.S.C. 522, while the treasurer claimed that the interests were statutory and not a judicial lien. But the bankruptcy court ended up ruling in the defendant's favor. What it really boiled down to was whether the state treasurer's lien was statutory or judicial. Statutory lien is a lien that arises solely by force of a statute, and a judicial lien is obtained by judgment, levy, question, or other legal or equitable process. The SCFRA, that the act that the treasurer was using under to get the reimbursement, provides a set of procedures that the state must follow in order to secure reimbursement for the state's cost of incarceration. Because the process is lined out in the statute itself, it makes the lien obtained by the state treasurer a statutory lien. And then because it was statutory, they were able to pretty much just avoid it, and the debtor was able to keep his exempt property, and the liens were removed from his property.
This is what you're seeing here is district court's affirmation of Judge Dale's opinion. I don't think this is on appeal, Judge Dale's, or no? I don't think it is it?
I don't think it is. I think the state kind of gave up, but.
What I thought was interesting here, not only the wrestling with the definition, determining that this was a judicial lien, that it's avoidable, but is the post-petition claim issue too. Because what the state wanted to do is, this debtor's in prison. All he has is his IRA. So they wanted to grab part of his IRA to satisfy post-petition obligations effectively. And Judge Dale said, and the district court affirmed essentially, that the state's claim was broad enough to include unmatured, contingent, unliquidated claims that are part of that same claim. And therefore, under 522C, that exempt property is protected from paying that claim. That didn't get a whole lot of discussion, but I thought that was one of the most interesting parts of that opinion, Judge Dale's.
Yeah, I think it goes to show you how powerful the bankruptcy remedy is from the point of view of a debtor in the very, very, very broad definition of what a claim is. And the state took a very temporal approach to the definition of claim, and they said, okay, even if you're going to wipe out our lien, you can't wipe it out for the costs of keeping him in jail that occur after the filing of his bankruptcy case. You can't discharge what they regarded as post-petition debt. The difficulty for them was that they argued in the circuit, the state circuit court, that they should have a judgment for the entire cost of his incarceration, which, because he was in for such a long time, was, I think 20 years or something post petition. And if you really drill down at the definition of what a claim is, and it's, the fact that the claim was unliquidated, that's clearly addressed in section 101 sub 5. That doesn't mean it's not a claim. The fact that it was contingent on how long he was in jail or parole or whatever, the contingency didn't make it not a claim. And it had obviously roots in the pre-petition period. And so essentially, it's my dog barking, I apologize. Essentially, it's a very broad remedy that you have in bankruptcy as a debtor. I'm going to put on mute now.
You got another debt collector at the door or what?
Yeah, I think it's Andy Gertis.
So, all right, let's go to Conti. Conti is a Sixth Circuit student loan case. Debtor was arguing that a loan was not a qualified student loan under section 523A8 and thus could be discharged. Went before the bankruptcy court. I think it was Judge MacGyver on cross motions for summary judgment, and the bankruptcy court granted summary judgment to the creditor based on the plain language of the loan. The facts were such that the debtor went to U of M, got a degree in musical arts. She took out 5 loans from Citibank, in total just over $76,000. So, this was a few years ago. The loan docs themselves indicated that the loans were for, quote, students attending 4 years colleges and universities, end quote. Citibank was a lender at the time. Citibank dispersed directly to U of M, and the loans did not exceed the cost of attendance minus other financial aid, although the debtor did try to make some of those arguments on appeal. Circuit said, affirmed the bankruptcy court and the district court, said, both parties agree that the court should look to the initial purpose of the loans, not the actual uses, to determine whether they fall within 8B. And the statutory definition focuses on whether the loan was, quote, incurred to pay, end quote, qualified educational expenses. Here, the debtor did claim that the specific recipient, U of M, and the cost of attendance and applicable financial aid are in dispute, but did not raise those facts below. There is no evidence in the record beyond allegations of the complaint that creates a dispute regarding these facts. Court went on to say there's no reason why the cost of education should fall outside of those definitions, and that's especially so when the loan amounts fall within the total cost of attendance minus any applicable financial aid. Decided based on the language, it went up in summary judgment. It's really, and I think this was the bankruptcy court record as well as is in the Court of Appeals record, and that is if you want to show, factually contest that U of M did not disperse directly, or Citibank did not disperse directly to U of M, or that the loans were for expenses other than educational expenses, you got to give us something. You got to put something in the summary judgment record so we can at least look at those and defeat summary judgment, and infer in favor of the debtor. There wasn't anything in the case to allow the court to do that, so that's how it held.
Can I make one observation about that too?
Yeah, go ahead.
I know we're lawyers, and we should want to dive into the statutes and the cross references, but I think most of us are good for 1, maybe 2 cross references tops. But if you look at the 523A8, I think it's A8B or A8B, the definition of this qualified education loan, it refers to Title 26. And it's worth checking out the definition in Title 26 as to what makes a loan qualified or not, because a lot can depend on whether the the nature of loan fits within the types of loans that Title 26 is addressing. And one little tidbit. I don't know if it is going to be of help to many people, but sometimes I see grandma in here with on the hook for a private student loan. And, you know, it might be worth taking a look to see whether a loan to grandma qualifies here if the student is not grandma's dependent. And the reason I mention that is, again, it's worth tracking down the cross references to see what qualifies. There's a lot in there. It's not enough just to look at the cross references, though, as Judge Boyd said. Then you're going to have to document the motion. And if you, this is aside from being an interesting case about student loans, it's a reminder to everybody that summary judgment will be entered if there is no genuine issue material fact, but you have to create a genuine issue material fact by pointing to documents in the record or affidavits or other evidence that would be admissible at trial. And if you simply make arguments, you run the risk that you're going, without offering evidence, you run the risk, as happened in Conti, that the court will say this record leads to this conclusion. It might have been a different conclusion if there had been other evidence on the purposes of the loan, for example. Cautionary tale.
Good point.
You want to move on to this Roman Catholic Diocese?
This is a case that I've been trying to avoid for the last year, or at least pretend it didn't happen. But you can tell me what it means, and that'll help me. Go ahead. So
this case has a really, you know, there's some really interesting issues in it that don't have anything to do with bankruptcy. It's awfully convoluted procedurally, and as I said, on the merits. Essentially, what we had in this case were, I think, retired school teachers in Puerto Rico, Catholic school teachers, who were looking to have their pensions paid by either the archdiocese or the school district, or eventually a trust that was set up to pay their pensions. And when the trust ran out of money and couldn't pay their pensions, the pensioners sued various ecclesiastical entities in the courts of Puerto Rico. So they sued the archdiocese. I think they sued the parish. I think they sued the school district, or the Catholic school system. There's all sorts of entities that may or may not be suable. So some of the issues on the merits involved whether these various entities are suable under the Treaty of Paris and some exotic historical documents that resulted in Puerto Rico becoming a Commonwealth of the United States. But that's not really what is an issue for us. While this dispute was going on in the courts of Puerto Rico, the trust that was originally supposed to pay the pension filed a Chapter 11 petition. So some of the defendants in the state court, in the Puerto Rican state court, removed the case to the United States District Court. They removed the claims against them to the district court based on the filing the bankruptcy petition by the trust. That's removal under 28 U.S.C. section 1452, the bankruptcy removal statute. While that, after they removed the case to the United States District Court, the trusts, apparently their bankruptcy didn't go very well, and the bankruptcy ended up getting dismissed. After the bankruptcy was dismissed, but before the district court remanded the removed action, the state court cranked up the judicial machinery again and entered a judgment against the archdiocese, directed them to make payments to the pensioners, and then sent the sheriff out to start levying on the chalices and everything else that the archdiocese may have, which of course excited the archdiocese to no end. And they ended up appealing up through the state system to the Puerto Rico Supreme Court. And then on writ of certiorari, the United States Supreme Court took up the case from the state court, from the Puerto Rican Supreme Court. And rather than reach the merits, let me add this before we go to what happened to the Supreme Court. The United States District Court, after the bankruptcy case was dismissed, got around to remanding the claims back to the Puerto Rico State Court. And in the remand order from the United States District Court, which was entered in August, the district court said, I'm going to wave my wand and make this effective nunc pro tunc to a few days before the state court entered the judgment against the archdiocese. The district court was attempting to make its remand order retroactively effective in an effort really to save the expense of having to relitigate what was going on in the state court. Because remember, procedurally and jurisdictionally, after a removal petition is filed, the state court can take no further action, and in fact is divested entirely of jurisdiction. And so what happened in the Puerto Rican Supreme Court is, at a time when they didn't have jurisdiction, because of the removal, even though the bankruptcy case had been dismissed, the district court hadn't remanded. So until the district court remanded, the state court had no jurisdiction. But even though they didn't have jurisdiction, they went ahead and entered this judgment against the archdiocese at a time when they had no jurisdiction. The district court, perceiving that, entered its order nunc pro tunc to try to bless what happened in the state court. Does that make sense? So on appeal, the Puerto Rican Supreme Court, or from the Puerto Rican Supreme Court to the United States Supreme Court, the United States Supreme Court said, we don't have to decide right now whether the archdiocese is a suable person, or whether the Roman Catholic Church is somebody you have to sue, or whether it's a superintendent of schools or the parish or whatever. We don't have to decide that, because the state court, in Puerto Rico Court of First Instance, entered its judgment at a time when it had no jurisdiction, because the removal petition divested the court of jurisdiction and the remand order hadn't been entered yet. And then the Supreme Court said, and listen, don't try to tell me that the nunc pro tunc effect of the remand order takes care of it. And that's when the Supreme Court uttered these fairly dismissive comments about nunc pro tunc relief. Basically, this is kind of what got everybody's attention. It says, federal courts may issue nunc pro tunc orders or now for then orders to reflect the reality of what has already occurred. Such a decree presupposes a decree allowed or ordered but not entered through inadvertence of the court. Put colorfully, nunc pro tunc orders are not some Orwellian vehicle for revisionist history, creating facts that never occurred. In fact, put plainly, the court cannot make a record what it is not. So it was a very negative view of nunc pro tunc orders, and a very limited view of nunc pro tunc orders. Now, in bankruptcy, we see nunc pro tunc orders sometimes when we don't even need them, but we see them. Your client goes and takes out a loan that they didn't know they needed the court's permission for, sells property they didn't know they needed permission for, does all sorts of things. And then you find out about it and you come running to the court, to the bankruptcy court, and say, I was, of course, not involved in this decision, but here it is. It landed on my desk. And can you, Your Honor, enter this order approving this transaction nunc pro tunc, now for then? And after this Supreme Court decision, I think we all have to hesitate before entering nunc pro tunc orders, because the Supreme Court was very, very hostile to waving the wand and making something that didn't happen. Now, that sounds kind of alarming, because there's lots of situations we have where there are delays. Sometimes you see in other contexts, you need to get appointed as counsel, and there's always a lag. Say in a Chapter 11, there's a delay between when you file the application to be appointed and when the court approves you. And many times we see, because of that delay, we see the lawyer saying, please approve my appointment nunc pro tunc. Okay, my point is, we we have to look carefully at this Supreme Court decision, because I think one way to look at it in a limited way is to say the federal courts, which includes us, at least for now, the federal courts are not authorized to enter orders that limit or expand jurisdiction. And really what the Supreme Court was offended by in this case, this is one approach to it, is the district court, by entering this order nunc-pro-tunc, it attempted to bestow jurisdiction on the state courts that Congress said they didn't have because of the removal. In other situations, you're starting to see the Supreme Court say, look, if the federal courts have jurisdiction, they have to exercise it. Don't come up with some stinking doctrine that says you don't have to exercise jurisdiction. Congress tells us what jurisdiction we have and tells us what jurisdiction we don't have. And you might look at this case as saying the district court can't rewrite the jurisdictional statute. Because of the removal, the state court didn't have jurisdiction, nunc-pro-tunc didn't do it. One other point I would like to make, or a couple points along the same lines, is there may be situations in which the statutes that you're relying on themselves contemplate, I won't say nunc-pro-tunc relief, but I'll say retroactive relief. And one that comes to mind that we are all familiar with is Section 362, which specifically authorizes the court to annul the automatic stay. And the language of annul suggests retroactivity. And in fact, it's designed, I think, to bless a transaction that occurred that the Sixth Circuit tells us under Easley versus Pettibone that actions taken in violation of the automatic stay are voidable and should be voided. But if the stay is annulled, which is a statutory remedy, maybe retroactive relief is okay, and you don't need to say it's nunc-pro-tunc. You don't cross what the Supreme Court is telling us in the Acevedo case. Let me also say, and this is my favorite point to make, and people are probably sick of hearing it, you may find some relief and some retroactivity built into state law doctrines that may come into play. For example, under the principles of agency, a principal can ratify an action of an agent, and Michigan law tells us that the ratification is retroactive. So my point is, don't overread Acevedo, be aware of it. Don't blindly ask for nunc-pro-tunc relief, because it's going to put our radar up after Acevedo. And think outside the box, like whoever it was that suggested Rule 60. Think outside in the other discussion on modification. Think outside the box. There may be retroactivity, which is really what you're after, built into the statute on which you're relying. Or you may not need retroactivity. For example, with respect to compensation decisions, right? The reason that lawyers say, please approve my application to be appointed as the Chapter 11 Debtors Counsel nunc-pro-tunc is because they want to make crystal clear that they can get paid for the work they did before they were appointed. And at least one court, I think several courts have said, there's no temporal requirement. You just have to be approved as counsel before you get paid, but that doesn't mean the approval has to be retroactive. So again, think carefully about whether you need retroactivity, whether there's a basis other than waving the wand, and whether what you're talking about is changing the record in a way that would offend the Supreme Court.
Judge Dales?
Yes.
I believe we're getting close to being the end of our time, and I believe you probably just answered the question that Mr. Ruckert had posed, but I do have a quick one from Kurt Steinke. For unapproved borrowing or sale property in Chapter 13 cases, we've been asking counsel to file plan amendment seeking forgiveness for the action rather than a motion for retroactive approval of the action. So I guess it wasn't a question, it was more of a statement, but.
Yeah, I don't think I've seen that, but again, that's an approach that would, if there were no objection, would result in the relief that you're asking for. And with a court order, assuming there's notice to everybody, that'll stick. So lots of ways to skin a cat, catfish. Last time I said skin a cat, all the cat lovers in the audience rose up against me.
Ryan, how are we doing on time? Are we pretty much at the end?
Yeah, Your Honor. I think if you guys do want to wrap up or keep going, I don't think there's an issue with that. I'm sure people would be excited or interested in sticking around.
You want to talk, you have time, Judge Dales, on full spectrum just to talk about it in the Chapter 13 context or no?
Yeah,
know
I'll
you've-
talk.
In a
Yeah.
minute.
I have a hearing at 2:30, but this should give me the discipline that I should have had earlier in the hour. Full spectrum, it was not a Chapter 13 case, but it was a Judge Boyd case in which the trustee had causes of action against a bank and against some insiders and their entities, and also against some entities that the debtor had done business with pre-petition. Unfortunately, as sometimes happens or frequently happens, there were no assets within the estate, no liquid assets within the estate with which the trustee could pay attorneys to prosecute the cause of action. And so parties thinking outside the box, the trustee cut a deal with the bank in which, as part of the settlement with the bank, the trustee agreed that the bank could have derivative standing to pursue avoidance actions against the insiders. The deal also contemplated the recovery that the bank would issue would be for the estate. At least there was a sharing agreement. So I think it was 25%. It doesn't really matter to this part of the discussion, but there was a recovery. So the point is the bank would be, if the settlement were approved, would be pursuing causes of action on behalf of the estate as a holder of derivative standing. This was part of the settlement, and it came on before Judge Boyd in a Rule 9019 motion to approve the settlement. And I think, and I didn't talk to you about this, Jim, but I think you were a little bit concerned to make sure that derivative standing under the circumstances here, under the Gibson Group case, made sense because it was a crucial part of the settlement. And of course, when we're approving settlements, we want to be careful not to approve anything that's unauthorized or illegal. We certainly can approve settlements under the standards, which I'll discuss in a second, but don't ask us to prove something that's unauthorized or illegal. And I think that might have been what was prompting the court in this case. So derivative standing, which is essentially defined as the authority of someone who's not the trustee, usually a creditor, to sue on behalf of the estate. We see it in the shareholder context sometimes, but here it's quite similar. The court authorizes a creditor to sue on behalf of the estate. In order to make the decision to authorize derivative standing, the Sixth Circuit in Gibson, the Gibson Group case, it's actually called Canadian Pacific Forest Products versus J.D. Irving, and that's referred to as the Gibson Group case, 66 F. 3rd, 1436. Under Gibson Group, in order to authorize derivative standing, a demand has to be made upon the trustee to commence the suit. The trustee has to decline the demand or the debtor in possession in a Chapter 11 proceeding. A colorable claim that would benefit the estate if it were successful has to exist. And the inaction of the trustee in pursuing the cause of action has to be an abuse of discretion or unjustified. That's the usual formulation in Chapter 11. Judge Boyd was evidently concerned that doctrine which came out of Chapter 11 might not be applicable in Chapter 7. So he investigated and found Sixth Circuit authority that applied derivative standing in Chapter 7 case. But even so, it was difficult, I think, to squeeze this settlement into the derivative standing requirements of Gibson Group, because here the trustee had commenced the lawsuit that we were talking about. So she didn't really decline to commence, although she didn't have the money to pursue it. And here, the trustee wasn't opposing the exercise of derivative standing. She was promoting it through her motion to approve the settlement, which put the court in a little bit of a bind, because on the one hand, you have to say that the refusal to act is unjustified. On the other hand, if you're going to approve the settlement as a justified exercise of the trustee's authority, how do you square those two things? And so I think Judge Boyd was endeavoring to address that potential inconsistency in the application of derivative standing in Chapter 7, where the trustee has run out of money or doesn't have money, and the trustee supports derivative standing. And the long and short of it is, again, Judge Boyd found a Sixth Circuit decision in Ray Trailer Source 555 F3rd 231, which, if you ask me, basically relaxed the justification or the unjustified refusal to commence. It relaxed that standard a little bit and supplanted it with a finding that it was best for the creditors and interested parties to permit the derivative standing. I don't know that there's any other way to look at it. And Jim, you can probably tell me what I'm missing, but I think that is really the nub of it. Is the Sixth Circuit probably didn't quite know how to do it either, because it doesn't quite fit.
Yeah, no, I would agree.
So let me just make an observation. I know I think I got to get on here shortly to the next hearing, but how will this work in a Chapter 13 case? I've got a matter, I think it's in Kalamazoo, where parties are trying to, maybe it's Grand Rapids case, parties are trying to resolve a controversy, and part of the resolution is going to involve derivative standing, where the bank will be able to have authority to sue the alleged recipient of a fraudulent transfer. But recall, in Chapter 13, you have to meet the Chapter 7 liquidation test. And as part of the Chapter 7 liquidation test, where we not infrequently take into account, oh yeah, you transferred a Dodge Durango to your grandmother, but you don't want your grandmother sued. So you're going to make a payment into, or payments into, the Chapter 13 plan to take into account the value of what would have been recovered if this had been a Chapter 7 case. And we get all that wrapped up at confirmation into Chapter 13. And then you say, okay, you passed the Chapter 7 liquidation test because you accounted for the avoidance and recovery of that Dodge Durango, for example. But how do we do that here if we are assigning that authority to a bank, for example, or some other creditor, and giving them the standing or the discretion, perhaps, to pursue and recover an avoidable transfer? How do we account for that at confirmation? I just raise it because the derivative standing, I think, could bounce or bump into the Chapter 7 liquidation test, and perhaps other issues in Chapter 13. I will say, too, one thing that troubles me a little bit about derivative standing is that standing is sometimes an argument that you confront in the adversary proceeding, where the defendant says, you can't sue me. You don't have standing to sue me. The case should be dismissed. And it's a little bit uncomfortable to have a court order that says you have standing, that may be binding on someone who is not participating in that proceeding. I don't think we had that issue in Full Spectrum, but I see you could have that issue, for example, if you're giving derivative standing to pursue a preference where the person who received the preference is no longer a creditor. Anyway, those are my thoughts on Full Spectrum. In terms of the settlement portion of it, it's just an excellent reminder or recitation of the TNT Ferry settlement standards, which are very deferential. The court, of course, has to apprise itself of sufficient facts to make a decision. You don't have to have a mini trial and all that. And the four elements are: consider the probability of success in the litigation, difficulties, if any, to be encountered in the matter of collection, complexity of the litigation involved, in the expense and inconvenience and delay associated with the litigation, and of course, the paramount interest of creditors. And as applied in the Full Spectrum case, there were, Judge Boyd found, and I think this also affected the trustee's decision to settle, substantial defenses on the part of the bank, which affected the probability of success. The difficulties of collection, Judge Boyd found there were no difficulties of collection here because the bank is clearly solvent. The complexity of the litigation, again, it might have been complex litigation given the bank's defenses, but the expense of the litigation was prohibitive because the trustee of the estate had no money. And ultimately, Judge Boyd found, and I think with good reason, that the creditors would be better off if somebody rather than nobody was pursuing an asset of the estate.
Okay. Brian, are we done pretty much here?
Your Honor, that you guys are the last panel of the day. So when you guys are finished,
Well, I'll tell you what, I've got about 4, I was going to switch gears. I've got about 4 sub 5 SBRA cases that I can talk about. I'm willing to hang around for 15 minutes to do that. I don't need to. And if folks want to drop off, that's fine with me. You tell me what you want me to do.
I would say go ahead, Your Honor. It looks like a lot of people are still hanging out. So, well, I'll say thank you, Judge Dales. We appreciate you giving the time and great job.
It's my pleasure. And thank you guys for organizing this in this horrendous time.
Yeah, thanks.
I am going to drop off for my hearing.
Okay. All
Thank
right, see you later. Yep. Okay, I'm going to talk just for a few minutes about small business cases, the sub 5 chapter 11 cases. And even though we usually think of chapter 11 as maybe not appropriate for consumers debtors bar, what we are certainly seeing is some involvement, either as debtors or creditors attorney in some of our cases, some of the involvement of our consumer attorneys. So I just wanted to run through some of the basics here without getting too detailed in it. I think everyone is generally familiar with the new sub 5 provisions of the code. And most of the cases really go to eligibility and that sort of thing. Thurman is up on the screen here. This was an individual chapter 11 case. Let me get to the right spot of mine. Prior to the bankruptcy, the debtors had operated a couple of pharmacies. When the case was filed, the LLC was not operating, had no employees, had few assets, no intent to do business in the future. Objection was filed as to whether it was an eligible debtor because the question was whether are they engaged in commercial or business activities. And again, definition of a small business debtor under 10151D is a person engaged in commercial or business debtors. Now, this court, which was Western District of Missouri from about a month ago, said, no, they were not, Thurmans were not as a matter of fact or law engaged in commercial or business activities on the date they filed bankruptcy. They had already sold the assets. They had no intention to return to business. And even though their LLC was still in existence, that didn't matter. They were not engaged in business, were not eligible. Other cases go the other way. There's a case called In re Wright out of South Carolina. And just by virtue of the fact that they were dealing with business debt in the case, the court said that was sufficient to be engaged in business activity. Easter, this was a question, is can a chapter 11 debtor after some period of time change its designation to become a small business sub 5 debtor? Here, the debtors filed a Chapter 11 petition in May of 2019. In July, they changed their designation to be a small business debtor. Nearly 12 months later, the debtor then filed a motion seeking to proceed under the new sub 5 provision. So once the new law went into effect, which was last February, they attempted to redesignate. Here, the court said there is no time limit for a debtor to make a sub 5 election. The big issues with a sub 5 election is under section 1188, there's a 60-day requirement for the court to conduct a status conference and for the debtor to attend. And the debtor is required to file a plan under 1189. The court can extend those deadlines, but only for circumstances for which the debtor should not be held accountable. And here the court said, even though the purpose of redesignating was to take advantage of the subchapter 5's new rule that there is no absolute priority rule, in effect, that there was no evidence to suggest the debtors were operating in bad faith, and the court allowed them to switch. Trepitan, again, the same sort of thing. The The debtor sought to proceed under sub 5 after the expiration of the deadlines under 1188 and 1189. The court said that the analysis is fact intensive and focuses on the debtor's conduct and potential creditor prejudice to the creditors. Here, the debtor filed a Chapter 7. Trustee filed a report of no distribution. The debtor then immediately tried to convert the case to a sub 5 case, which it did. And the court said that even though technically couldn't comply with those sections, that the fact that it could not comply with those time requirements, the 60-day and the 90-day requirements, was not circumstances for which the debtor should be held accountable. Other courts go the other way. 7 Stars on the Hudson from Florida earlier this year. Similar facts, different results. Simply said that the Trepeton case was wrong. Actually said that under those circumstances in the last case where the debtor converted it after the trustee filed the no asset report, that those circumstances were under the debtor's control and the debtor should be held accountable for those, and there should be no extension of deadlines. Chapter sub 5 is intended to be an expedited process, and by allowing the debtor to redesignate at a late date doesn't accomplish that. What's a trustee do in a sub 5 case? AGM Hospitality talks about that. The duties of sub 5 trustee are set forth in section 1183 and are similar to a Chapter 12 trustee. The trustee is required to perform the duties as outlined under A2, account for property, A5, object to claims if appropriate, A6, post discharge if appropriate, A9, file a final report. And then the court may order the Chapter 11 sub 5 trustee to do other duties. And here the bankruptcy administrator had asked the court to broaden the trustee's duties to have the trustee review and make a report on intercompany claims. I actually had a sub 5 case where at confirmation, I ordered the trustee to file post-confirmation reports dealing with projected disposable income to make sure that the debtor was complying with that. And then last but not least, Ellingsworth talks about confirmation requirements. Here, an unsecured creditor objected to confirmation. Suffice it to say that under section 1191B, as long as the court finds that the plan is fair and equitable, the court can confirm the plan over the objections of an unsecured creditor, even if the debtor is retaining the property. Again, there's no absolute priority rule. So in that situation, that case actually walks through the confirmation standards. So that's just a real brief outline of some of the SBRA cases. Very few have gone up on appeal because it's relatively new, and they're still coming out on a regular basis. So I think with that, Ryan, I think we're concluded, and I would thank everyone for participating, and appreciate, Harley, all of your input, and do appreciate the Debtors Bar for setting this up, as Judge Dale said, in these very odd times.
Thank you, Judge. Thank you, Harley. If you're, oh, yeah, there she is. Thank you.
Thank
Harley.
you.
Thank you for everybody for attending. We'll be back again Monday, same start time, 12 p.m. Again, we'll be using the same Zoom link, and some materials, additional materials will be going out via email pretty soon here. If you have any questions in the meantime, again, you can send questions, concerns to the Debtors Bar Seminar at Gmail address. Thank you, and have a great weekend, everybody.
Thank you.